Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world and find the hidden stories in their filings. Today we're diving into some new debt disclosures from PepsiCo Incorporated. Let's see what the fizz is all about. Alright, so the first thing that pops out from these documents is that PepsiCo Incorporated is really keeping tabs on all its different types of debt. They list out a bunch of different notes, which is basically just a fancy word for loans that the company has taken out. Think of it like a big company borrowing money from a lot of different people or institutions. What is interesting here is how they break down these loans by how much interest they have to pay and when they have to pay it all back. For example, they have these 2.625% notes due 2026, which means they borrowed money and they are paying back a little over 2.5% interest each year, and the whole loan is due in 2026. They have a whole list of these, with different interest rates and different due dates stretching out for years. It's like a menu of debt, and they've clearly laid out what each option costs. Some of these loans have pretty low interest rates, like that 0.75% notes due 2027, for instance, which is a very small cost for borrowing money. Then you see others like the 3.2% notes due 2029, which have a slightly higher interest rate. This tells us PepsiCo Incorporated is managing a varied debt portfolio, probably to balance costs and when they need to repay the money. Looking further out, they have notes due in 2031 with an interest rate of 1.125%. This shows they are planning their finances way into the future, making sure they have money set aside or plans in place to handle these upcoming payments. They even have a loan with an incredibly low interest rate of 0.4% due in 2032. That is almost free money from a borrowing perspective. And then you have slightly higher rates like the 3.55% notes due 2034. By having this mix, PepsiCo Incorporated is likely hedging against future interest rate changes and optimizing their borrowing costs. They are really spread out, with notes due as far as 2039 at a rate of 0.875%. This long-term planning is a sign of a mature company that understands the importance of managing its financial obligations over extended periods. Now, all of this debt is tied to their business operations and likely helps fund things like new product development, marketing campaigns, or even acquisitions. Remember, PepsiCo Incorporated is a massive global company, so they are always investing to stay ahead. The fact that they are filing this with the Securities and Exchange Commission, or SEC, means they are being transparent with investors about their financial health. Transparency is super important for building trust. They are essentially saying, here is how much we've borrowed and what it costs us. Beyond the debt, the filing also lists their common stock, which is what most people think of when they hear stocks. This is their ownership stake in the company. The ticker symbol for their common stock is PEP, and it is traded on the NASDAQ. This is how you'd find them if you wanted to buy or sell shares. They also list specific trading symbols for some of their debt, like PEP26 for those 2.625% senior notes due 2026. This shows that even the company's loans can be bought and sold by investors on exchanges, which is pretty common for large corporations. And you see other symbols like PEP27 for the 0.75% senior notes due 2027. This granular detail emphasizes how actively traded and managed their debt instruments are. It is fascinating to see how many different pieces of debt they have outstanding, like the 0.500% senior notes due 2028, with its own trading symbol PEP28. This variety allows them to tap into different pools of capital and manage their repayment schedules effectively. They even have notes going way out to 2050 with a rate of 1.050% senior notes due 2050, traded under PEP50. This long-term horizon is impressive. And then there are those 4.050% senior notes due 2055, traded as PEP55. Having debt instruments with such long maturities indicates a strategic approach to financing long-term projects or maintaining a stable capital structure. Now, a really key part often tucked into these filings is the Regulation FD disclosure. This basically means that when the company releases important information, they have to make sure everyone gets it at the same time. No favoritism for certain investors. In this case, on the 8th of December 2025, PepsiCo Incorporated put out a press release. They talked about their plans to make shareholders happier and gave a sneak peek at their financial predictions for 2026. This is where they're sharing their strategy and outlook. And finally, under exhibits, you see what other documents are attached. The most important one here is Exhibit 99.1. This Exhibit 99.1 is the actual press release from the 8th of December 2025. That is where you'll find all the juicy details about those shareholder value priorities and the preliminary 2026 outlook they're talking about. It's like getting the company's own summary of their recent announcements. Alright, so what does all this mean for PepsiCo Incorporated? On the surface, they appear to be a company that is very deliberate about managing its debt. They have a diversified debt structure with various interest rates and maturity dates, which is a sign of financial sophistication. This strategy likely allows them to weather economic ups and downs and fund their ongoing operations and growth initiatives effectively. The range of interest rates from extremely low, like a fraction of a percent, to around 4% suggests they are able to secure favorable borrowing terms, possibly due to their strong credit rating and established market position. The extended maturity dates, some going out to 2055, mean they have a long runway for repayment, giving them financial flexibility. However, it is always worth remembering that taking on debt, even with low interest rates, does represent a financial obligation. A significant economic downturn or a sharp increase in interest rates could put pressure on their ability to service this debt. While they are showcasing priorities to enhance shareholder value and providing a 2026 outlook, the devil is always in the details of that outlook, which we'd need to examine in the attached press release to fully understand. Overall, PepsiCo Incorporated seems to be in a solid financial position regarding its debt management. They are leveraging the debt markets strategically to support their business. The key takeaway is their proactive approach to financing and their long-term financial planning. What is your take on PepsiCo Incorporated's debt strategy and their future outlook? Do you think their approach is smart and safe, or are there hidden risks? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up, and if you want more deep dives into corporate filings, make sure to subscribe, and don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and I'll see you in the next one.